AI bubble has reached a staggering scale that dwarfs previous market bubbles. The global AI spending is expected to hit $375 billion this year, forecasted to climb to $500 billion by 2026. Despite these enormous investments, warning signs are emerging. According to a recent MIT study, 95% of firms that adopted generative AI did not profit from the technology at all. Additionally, infrastructure operators are borrowing more than $1 trillion to build data centers. However, the disconnect between investment and returns raises serious concerns. OpenAI has already made around $1 trillion in AI deals, including a $500 billion data center buildout project, yet is set to generate only $13 billion in revenue. So in this video, we will explore the factors indicating why the AI bubble appears unsustainable and is likely heading toward an inevitable burst. The investment in AI has reached unprecedented levels. In Q1 2025 alone, AI startups raised $73.1 billion, representing 57.9% of all venture capital funding globally. This marks the first time AI has captured the majority of VC investment. Furthermore, the average AI deal size in 2025 stands at $49.3 million, a staggering 86% increase from 2024. Particularly concerning is the valuation to employee ratio for certain AI firms. Some early-stage ventures now command between $400 million and $1.2 billion per employee. Figure, a humanoid robotics developer, leads with $104.3 million per employee on a $39 billion valuation, yet reported no revenue last year. The gap between investment and tangible results continues to widen. Equally troubling, only 26% of companies have developed capabilities to generate tangible value from AI. Resource allocation remains problematic, with over half of generative AI budgets devoted to sales and marketing tools. The AI market exhibits dangerous concentration among a handful of companies. Nvidia dominates with approximately 92% of the data center GPU market, creating significant dependency across the entire AI ecosystem. OpenAI, Anthropic, and Mistral AI received the three largest funding rounds in Q3 2025, reflecting the excessive capital flowing to frontier model developers. Significant doubts exist regarding AI's long-term value proposition. A recent survey revealed that although 68.3% of experts believe good outcomes from superhuman AI are more likely than bad, nearly half of these net optimists still gave at least a 5% chance of extremely bad outcomes such as human extinction. Indeed, between 38% and 51% of respondents assigned at least a 10% probability to advanced AI leading to outcomes as catastrophic as human extinction. This uncertainty makes effective, definitive, long-term AI strategy setting particularly difficult. Pure-play companies, those whose fate depends entirely on a particular innovation, are essential components of any bubble. In 2025, a remarkable 58% of all venture capital investment went to AI companies. Pure-play AI firms like Perplexity, valued at $20 billion, and CoreWeave, $61 billion market cap, exemplify this trend. As with Tesla's $1.5 trillion valuation, compared to Toyota's $273 billion, despite Toyota's superior production and revenue, pure-play AI stocks command extraordinary premiums over traditional businesses. The democratization of investing has enabled unprecedented retail participation. In 2024, Nvidia became the single most bought equity by retail traders, who invested nearly $30 billion into the chipmaker. This retail enthusiasm extends to other AI-adjacent tech stocks like Microsoft, Meta, and Google. The AI sector thrives on narratives of technological inevitability. Many industry leaders promote the idea that artificial general intelligence will soon perform any human task, ushering in unprecedented technological capabilities. In reality, generative AI has entered the trough of disillusionment in Gartner's 2025 hype cycle as organizations gain understanding of its potential limits. Despite an average organizational spend of $1.9 million on Gen AI initiatives in 2024, less than 30% of AI leaders report their CEOs are satisfied with AI investment returns. The AI infrastructure expansion now relies heavily on borrowed money rather than cash reserves. Goldman Sachs reports that AI-related companies have accumulated $141 billion in corporate credit issuance in 2025 alone, exceeding the entire 2024 total of $127 billion. This shift toward debt financing is marginally reducing corporate credit quality, introducing leverage risk absent from previous technology buildouts. Moreover, organizations face growing hidden liabilities through insurance exclusions, as 50 to 75% of companies have incorporated AI into operations, while insurers implement broad AI-specific exclusions in their policies. A troubling pattern of interdependent financing has emerged among major AI players. OpenAI receives billions from tech giants before funneling those same billions back to purchase computing power and services. For instance, after receiving $13 billion from Microsoft, OpenAI sent most of that money back to Microsoft for cloud computing. This circular money flow obscures true demand and creates networked fragility where the failure of one participant could trigger cascading defaults. The fundamental issue isn't AI model quality, but flawed enterprise integration. In fact, OpenAI still loses more money than it makes despite billions in investments. This gap between investment and returns creates mounting pressure as debt financing increases. Four tech giants, Amazon, Meta, Microsoft, and Google, are expected to spend $320 billion on CapEx in 2025, primarily for AI infrastructure. This massive infrastructure investment, without proven business models, resembles the dot-com bubble, which peaked on March 10, 2000, after the Nasdaq rose an astounding 600% between 1995 to 2000, subsequently plummeting 78% by October 2002. Telecommunications companies invested approximately $500 billion in infrastructure, primarily financed with debt. Ultimately, 85 to 95% of the fiber optic capacity remained unused 4 years after the bubble burst. So I hope you guys enjoy this video. Leave your thoughts in the comments section below. Hit the subscribe button and like this video for more such content.